Nigerian market has really lagged other emerging markets for the 2009-2010 period. What catch-up potential are we looking at from your perspective, given the way that the market has performed so far this year, where it's been pretty erratic?
Well, good morning, Alishia. Thank you for that question. We think that there are a number of positives that have filtered through, particularly on the macro side of the, what you call them, market fundamentals. We've seen a lot of activity by AMCON. We've seen, more positive developments, and I think more recently the, Eurobond issues by the federal government has, pretty much underscored the resilience that, the Nigerian economy continues to present. On a year-to-date basis, the market has done about 12%. I think a lot of that has been with a lot of volatility in between. Noticeably, most of the volumes that have driven, this market appreciation has been, from the banks. Quite clearly, I think the outlook is a bit more positive on the fact that financial sector is a lot more stable following the activities of the CBN, and we continue to get reassurance that indeed, since none of the banks are going to fail, earnings, look a bit more positive. We think that there is quite a significant room for upside this year.
With that, the kind of sentiment that's out there in terms of activity, what kind of participation are we seeing and on what kind of volumes, just so that we can gauge the breadth of the participation in this market at this stage?
I think first things first, the extension of trading hours by the NSE, additional 2 hours of trading, led to some immediate increase in traded volumes. Where prior to Christmas, sometime in December, we used to see volumes less than 2 billion a day. We're currently seeing, in fact, in some days in trading, we've seen as much as close to 4 billion, change hands. More than, in some cases, between a 50 and 100%, increase in volumes. Although a lot of that is still driven by banks and primarily FMCG companies, we still think that a lot of that is expected to continue largely, given to that. And if you had to factor in a lot of the liquidity that we'd expect to come into the economy, due to election-related spend, the injection of more additional bonds by AMCON, we think a lot of the cash that will filter through into the economy would perhaps begin to chase more equities.
We had Citigroup this week saying that Zenith, First Bank and UBA are the banks to watch this year, where a lot of activity, as you alluded to earlier, is still within this space, and the belief that they're running with is that the big will get better. What's your view? Do you share that kind of sentiment?
Well, we do indeed watch for those particular banks. First Bank, UBA, GT Bank, obviously appear to be, as it were, the best in class if you're looking at the financial services space. But I think more primarily the fact that between the top-tier banks, that is 4 of them, UBA, Zenith, GT, and First Bank. These 4 banks account for 65% market share, from an asset perspective. And if you were to factor that into the Nigerian economy, where a lot of transaction-related, income would be generated, we think that those banks are in for, pretty, decent upsides in terms of earnings. This should obviously trickle down and filter through because if you look at them as well, they seem to be on the back of, more robust IT platforms, perhaps much more efficient processes. They would obviously be able to deliver more additional profitability, better profitability than some of their peers. And we think that that will obviously be a major factor to watch in terms of market drivers.
Let's tackle them one by one. I mean, Zenith Bank, this is the company that seems to have least risk to attach to it, and the appeal seems to lie in the fact that it sits with a very low NPL ratio. It's sitting sub 6% at this stage.
Well, that is actually very correct. Zenith obviously has been known for, its pretty risk-averse, stance, with respect to loan growth. However, that said, the bank still does, significant portion of what you will term the corporate, banking, space. They are pretty efficient, IT and technology-driven. I think pretty focused as well. Given the what you call the change of succession, where we've seen one MD leave and another replace him pretty smoothly, we think that the bank is significantly well poised to continue to deliver shareholder value on account of its efficiency and brand strength.
First Bank, in the meantime, seems to come with a medium risk attached to it. So what are we looking at there? Just how much potential upside are we looking at on that share price before it stands at fair value in your books?
First Bank is currently trading, plus or minus 15 naira. we still think that there may be perhaps 15 to 20% upside on that stock for the year. However, the increased risk perception that you mentioned is largely attributed to the fact that the bank has chosen to adopt the holding co structure. There are double taxation implications for some of the subsidiary companies, and of course in terms of strategy and market coordination, it may present a challenge. It may take a while to ramp up, but we think that given the strength of its businesses, it should be able to within the medium term become a major force to reckon with. I think some of the other banks like a GT, who has made it clear that they're going to be going monoline, would on the short term be able to just focus on their core competence and deliver extreme really robust numbers in terms of bottom lines. GT obviously being the most efficient bank on the entire banking landscape, pretty focused, extremely strong brand, good quality credit as well, and a pretty diversified what you call funding source base. We still think that GT obviously also do hold some significant upside potential as well.